Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with my friend and colleague, Jeffrey Roach. Thank you for joining, Jeff, to talk economy, even in the absence of economic data. How are you?
Doing well. And of course, it's all coming back. The return to office, you could say.
It is coming back indeed. I'm kind of looking forward to it, actually. It's kind of nice to know, get a full picture of
Uh,
what the
hey, it's
economy is doing,
it's
which we'll
been
get.
a great opportunity for those that provide private sector snapshots. Boy, I've noticed a number of firms have jumped at the opportunity. They're now in the limelight, and it's been good for them as investors have not had the official government data. The switch to the private sector.
Well, good for them. We certainly appreciated having enough data to make a pretty good assessment of the economy, but maybe not quite as good as if we get the full data set. As you could probably tell already for regular listeners, I'm fighting a little bit of a cold, but I think I'm going to be able to get through this. I've got a glass of water here in case I need it. If you see me coughing, Jeff, you just keep talking.
I
So
got you covered.
that's
Team effort.
it. I don't feel too bad, but definitely don't I think sound like I normally do. So here's our agenda for today. Market recap. I titled this section "Hard to Believe the S&P Rose Last Week" because it sure didn't feel like an up week. Now, granted, it was barely up 0.1%. Actually, you had to round it to get to 0.1%, but nonetheless, it was up last week. We are selling off just a little bit as we're recording this on Monday. It's November 17th, 2025, just shortly after lunch here in the East Coast. The I mean, I guess the two biggest drivers of the weakness were AI skepticism for one, and then Fed hawkishness number two. So we're going to talk about both those a little bit. Next, we will talk about the weekly market commentary, which you can get on LPL.com under research. That is early keys for the markets in 2026. Certainly AI and the Fed top the list. And then finally, preview the week ahead, which really isn't that data heavy, at least not in terms of significant data, because the jobs report will be stale. We're getting the September jobs report about 5 weeks late. Beyond that, there's not a ton of interesting data, but Jeff, you'll tell us what to watch. And then we get NVIDIA earnings plus a bunch of retailers reporting. So, frankly, I'll be very interested in those particular earnings reports as earnings season wraps up. So let's do the market recap here. You can see this is the S&P 500 up for the last 5 days, 0.1%. Really, again, hard to believe with the volatility. As we all know, we got a little bit more volatility last week than we've been seeing in recent months. But given the market, Jeff has worried more about the Fed and about whether AI spending will actually come through. Maybe it's not too surprising that we had more volatility last week. Your thoughts?
Well, I think we got used to very low volatility the previous few weeks. Of course, after say maybe end of summer, doldrums. So maybe it's just getting back to what we expect as we go to a Fed meeting in December when there's still a lot of debate. What's more important? Is it a weak job market or is it hot inflation? And what are they going to focus on? And it does seem like it's moving back and forth. The pendulum is swinging both sides, hence the volatility. I think one of the things that's worth highlighting though is you think about year-to-date numbers for the S&P relative to year-to-date numbers for Europe. I don't want to get too ahead of where you want to go with sectors, but um, despite a little bit more choppiness because of that uncertainty on Fed policy in the near term, it's not a bad year to complain with. 2025 is so far is looks like it might be a decent year when we reset the clock here for 2026.
Yeah, it's going to be hard to do much better in 2026, assuming these gains for this year hold up through the rest of the year. So no doubt, pretty solid year. Well, it's been a solid year for communication services and tech, certainly, if you want to talk year to date. Both those sectors up 20% plus. We still like communication services, getting a nice rally in Alphabet shares today on news of a Berkshire stake in the company. That always helps. So, getting that sector off to a good start today. I think the big story last week, though, was healthcare up almost 4%. It was some of the big names. Lilly was up over 10% last week. Strong week for Merck. It's a really big pharma, actually Amgen in the biotech space. So a big week for healthcare, led by the big names. It's really hard to know if that's. I mean, I know that GLP-1 is have generated a lot of excitement among investors, but beyond that, it's really hard to know whether this is just a rotation because the market is looking for cheap areas that have lagged, or if there's really some fundamental excitement in healthcare that's pushing that sector higher. It's probably a little bit of both, but I would argue the rotation and the fact that the sector has lagged so long is probably the biggest reason why it has been working lately. Tech, despite all the scrutiny on AI and concerns about whether that spending is going to happen, was able to eke out a 0.5% gain last week. Certainly, Microsoft helped. That was up last week. And then Cisco had good earnings, well received by markets. That was a big winner last week. Moving on to the bond market, of course, here's your Fed hawkishness again. We had the bond market selling off just a little bit, rates ticking a bit higher. I mean, Jeff, maybe we'll save the comments on the Fed when we get to that key for 2026 slide. But anything here you want to highlight, either in terms of commodities, currencies, or really commodities, currencies, or fixed income, frankly, that we haven't
Yeah,
hit on yet?
I think yen is still worth tracking. If you look at bottom right section there, the Japanese yen in the 155 range, still having that potential for who knows, maybe not as bad as what we've seen in the past with that unwinding of the carry trade. Remember, that's all about borrowing in low interest rate or low cost areas to invest where the opportunity for triangular arbitrage is one way to think of it. But when you think about that weak yen, that's still worth tracking because of all the central banks out there globally. The Bank of Japan is the only one of consequence that's tightening policy, raising rates because of where the Japanese economy is. So that's worth tracking, especially as you tie it into what Nikkei's done this year. Quite a nice performing market. So that's it. That's it from this slide, I think, for me.
Yeah, the oil markets haven't been particularly interesting. Energy stocks had a nice week last week, but actual crude oil at $60 hasn't really moved much at all lately. We'll continue to watch it, but for now, expect it to stay range bound. So in terms of what we're watching for 2026, this is kind of a technical take. We'll be watching the narrow leadership in the index concentration. So that's what this chart shows. You've got the typical 50-day and 200-day moving averages that we always show with the S&P 500 here. But then you also have this shaded line, this kind of area line in the background that shows the percentage of stocks above the 200-day moving average within the S&P 500. And you see here we've come down from where we were most of the last couple of years, but not much. We're still at the last tick around 60%. That'll come down a little bit today, but that's a solid reading. Not table pounding bullish kind of a reading, but pretty solid. So for now, we're comfortable with the breadth and the index concentration. But we'll just have to continue to watch this. It's been a story for really the last 3 or 4 years, and it'll continue to be one in 2026. So that's the first chart from the weekly market commentary. This week, we'll get into what I would argue would be the biggest two keys to 2026, AI and the Fed. I hate to give the Fed too much worth in terms of how it's going to be important, but it is going to be important because we're at this kind of inflection point where you've got hawks and doves trying to come together. You have the leadership changes, Jeff, that I know you have some thoughts on. But before we get into that, let's talk about earnings. The first key for 2026, S&P 500 companies have to hit these earnings targets. Right now, consensus reflects 14% earnings growth 2026 versus 2025. That is a big number. The average is more like 9% on S&P 500 profit growth. Stimulus is going to help and AI is going to help. But if we get disappointments of any kind and we don't hit these numbers, that's going to make the S&P 500 a little bit tougher to generate the double-digit returns that a lot of people expect even next year. So all of these keys to next year tie back to AI. And so you're going to continue to hear that from us as we go through these slides. But number one, hitting these lofty earnings targets. By the way, Q3 earnings season, I've been very impressed. The margins ex financials are up quarter over quarter. That is despite the fact that tariffs paid in Q3 were higher than tariffs paid in Q2. So you had to absorb more tariffs and still were able to grow margins. That's really impressive. And earnings are going to end up growing in the mid-teens when all the numbers are in. If you take out Meta's tax charge, which is 2% of EPS for the S&P. So that's key number one. Jeff, over to you. The start of, or the continuation of the AI discussion. Another key is AI adoption, and then related to that is what it's going to do for the job market and productivity.
Yeah, and I think this is a great segue, really, from your comment about the fact that businesses were paying tariffs like they, higher than they were the previous quarter, and at the same time you saw this rise in margins. I think what the AI story tells you about the next few quarters is that you actually have an opportunity to continue to manage those costs on the corporate side, because adoption rates are still very low in several sectors. So I'm just showing you a chart here, adoption rates for major industries at the bottom part of the chart. Information technology, no surprise there, over 70% adoption rate. You'd be nervous if it were anything lower, right? Elon. But what's interesting is as you read up that chart, accommodation, food services, think restaurants, hotels. You think public administration, think services, industries, healthcare. Some of those are in the 25 to 35% adoption rate. That's pretty low, meaning that there's plenty of room to have that utilization rate increase, and hence, at least the hope is, greater adoption rate would allow firms to manage those costs even better. So to put in perspective on that previous chart, Jeff, as you're showing 2025 numbers and then 2026 numbers, you think, wow, how in the world can this keep going like this? It's possible that AI will provide that long run productivity bump to manage the cost. So keep your eye on accommodation, food services. Keep an eye on some of the highly labor intensive service sectors and see where they're going in terms of AI adoption rates. That's certainly going to be really important to track as we head into the new year.
Yeah, I'm not surprised that our industry, Jeff, finance and insurance is high. We're certainly using it here, not just in the research department for LPL, but also LPL advisors have some AI tools. So it's become really pervasive in our industry, which is reflected here with this high bar, I guess you could say, 60%. All right, so let's go to the Fed now. We mentioned a couple times already. This is the implied Fed cuts from the Fed funds market. So Jeff, I know that the odds of a rate cut in December have plummeted. Now I think they're even under 40% now. They ended last week around 40%. Do you think that's right? What do you think of this sort of rate cut profile priced into the bond market?
Yeah, I think what this chart tells me, and I think this is the right way to expect things to play out, is throughout the new year at least, and even when you add in December, we're in a trajectory where rates are going to be lower and lowered consistently throughout the next, say, 18 months. So when you go to, late 2026, early 2027, you're going to see the Fed continue this rate cutting campaign. That's consistency of cutting rates. Maybe if they hit one meeting and there's a pause, but in terms of just the overall trajectory, that's going to flow into, downward pressure on some of the retail rates, especially if we get our fiscal house in order and the 10-year stays well anchored where it is. I'm looking at my screens here. We're looking the 410-ish range on the 10-year. Uh, that's important, by the way, when you think about retail rates. When I say retail, I'm talking about your bank rates for your CDs, your auto loans, mortgages, all those retail rates. Track uh, probably a little tighter with the 10-year, but it's all related ultimately to how Fed policy is. I think um, to the very near term question, Jeff, that you're asking about, I think the fact that there has been a little bit of limited visibility on the inflation outlook, especially as government agencies were closed for a little bit over 40 days. I think that's just made investors just a little bit more nervous that inflation has been running hotter than how the Fed wants it to run, and hence uh, pushing the probabilities a little bit lower on what they do in December. I think we are in a position where inflation is running hot, but by the time we get November data, um, now depending on how Fed looks at it, maybe they're not going to have that data quite yet. December 10th is their next meeting. I think that it's going to be a close call for December, but on net, I think we do see inflation easing up. This is not the kind of environment that it was like 2022. Um, where we were going in the other direction with inflation. So uh, complicated chart here, but when you think about it, it makes sense throughout 2026. I think what's a little bit interesting, and of course, it's a little bit of a wild card when you start thinking about 2027, and you see that blue line there with the overnight rate, the implied Fed funds rate actually um, going back up a little bit. That's basically just saying, hey, we expect no recession. We expect the economy to actually have some tailwinds. So by the time we roll into 2027 and 2028, the Fed can actually tighten up again as the economy is humming. But boy, um, that there's a lot of things that could happen, and the confidence intervals are pretty wide when you think about that far out in history.
Yeah, so it is a little bit of a complicated chart, but this is just the number of cuts on the right, 25 basis point cuts. So this is saying the most cuts you're going to get in the next couple of years is three, and then you're going to head, or a little more than three, and then you're going to head back up. That's probably, or at least to me, it says that maybe the Fed overcuts. Now, the makeup of the Fed is going to change, Jeff, as you know. That probably makes it more likely that we're going to get those three and potentially more cuts, wouldn't you say?
Well, it's there's a real chance that the Fed overall board of governors moves a little bit more toward that dovish um, view, and dovish just means they're more inclined to ease up on rates than leaning toward increasing rates. That'd be your hawkish view is nervous about inflation. Dovish view is nervous about a weak economy. So I believe the latest is that somewhere around Thanksgiving time, maybe a little bit after, we might hear who might be on the short list or who the actual name will be to replace Chair Powell when his term ends in 2026. It's possible, who knows, but it's possible that Chair Powell gives up the chairmanship a little bit early. It's not necessarily, I don't have a strong opinion on that. But I think what's interesting is you think about who's on the short list. It's possible that we'll have a slight dovish tilt overall in central banking by the time we uh, say hit Q2 of 2026.
Yeah, that's going to be interesting. I guess what names you hear? Hassett, you hear Waller, Warsh, um, Rick Reeder from BlackRock. I think are those maybe the top four.
Yeah, that's right.
Maybe Byron. Yeah, so it'll be interesting to see. But I mean, all of those candidates probably would be a little more dovish than Powell, I would say. The Fed, I try not to pay too much attention to gaming each meeting as an equity guy, certainly. But the Fed really matters for equities because of how important rates are for
Hmm.
equity valuations and because of how important financial conditions are for the equity markets and liquidity, right? And so if you get a really hawkish Fed or stickier inflation the market expects in the next few months, that will create a headwind for equity markets. It's no doubt. So we'll
Yeah.
have to watch the Fed. It absolutely is a key to 2026. It's key to most years, but I think it's going to be really interesting in 2026 because of the changing makeup of the Fed and the fact that stock valuations are high. Yields might end up staying in the range that they're in, the 10-year yield, for example. We don't have a formal forecast yet. You will see that in the outlook for 2026 when we publish it, which is coming in just a few weeks. But certainly don't expect us to make any bold call on long-term rates one way or the other. So speaking of long-term rates, here's our next key: uh, deficit spending. Now, I mean, Jeff, here's where the tariff revenue is really important, right? Because we have a lot more deficit spending coming from the One Big Beautiful Bill Act, which would, all else equal, take the deficit as a percentage of GDP above 6, right? Again, probably even 7. But we've been able to offset that with tariff revenue. So this chart shows you the projected by the CBO projected deficit as a percent of GDP. It's pretty much flat for the next 10 years. Do you buy that, Jeff? Your thoughts on this?
Yeah. Well, I think it's fair to say, think about several years out, you see the bars getting shorter, 2026, 2027, and then kind of, getting back where we're seeing it in 24, 25. And I think the wild card here is, I think hands down, the revenue from tariffs going to be helpful for 2025, maybe early 2026. But over time, businesses will have the ability to shift production from high tariffed countries to lower cost tariff countries to domestic uh, activity. Hence, that substitution effect, I think, will actually dampen what we might expect from tariff revenue, say, 2 years from now, where businesses have that time to respond and readjust here. So it makes sense. I think a lot of this is baked in, how we can grow despite a shrinking labor force. Can we still keep this robust clip of growth? The answer is yes, if we can harness the abilities from AI. So I think this flat line, we're not going to see a ton of improvement long term, but this flat line makes sense to me. I mean, if anything, say 3, 4 years out, this deficit will probably look a little bit worse than what we see here in this chart.
Yeah, and certainly, given the Trump administration's focus on affordability, now they're talking more about exemptions on tariffs. So that means less tariff revenue and therefore higher deficits. So yeah, I would buy that, Jeff, that maybe this picture gets a little worse than this over the next several
Mhm.
years, but we'll just have to see where the path of tariffs go. Hopefully, we'll get more growth than the CBO expects, and you can kind of grow into this deficit. But I think it's been proven for quite some time, unfortunately, by Congress that they're not willing to cut spending in any meaningful way,
Right.
despite some efforts
Well, and
from
I think
Doge.
we've also been able to prove that the biggest bang for your buck is not necessarily cutting spending, although I'm all for getting rid of wasteful spending. But what's most powerful and most impactful is solid growth. Pro growth policies, economy can grow out of a deficit problem a lot faster than Congress cutting spending as a way to solve the deficit problem.
Good point. And it's going to grow out of this a little bit in Q3 because it looks like the Q3 GDP is going to be pretty good.
Hmm.
So amen to that. We want more growth. And here's where the AI ties in. You mentioned it, productivity. If we can get more productivity, that can help us grow faster with less inflation. So I think we tied AI to every single key to 2026.
That's good.
So you can find all that in the weekly commentary again on LPL.com. Team effort. You and me, Jeff. It was more than the Jeff and Jeff show. We also had Lawrence Gillum and Adam Turnquist chime in. Adam had a technical setup take, and then Lawrence on the bond market and deficits. Myself on earnings and the AI capex ramp, and Jeff, you on AI adoption. So good commentary. Check it out if you're interested. Let's end here with the week ahead. It's NVIDIA earnings and a stale jobs report. So any thoughts on
Yes,
that jobs report, Jeff?
I would
Or
say,
what other data should people be watching?
yeah, I would say the way the setup here with NVIDIA and stale job reports definitely doesn't make it very exciting when you think about the data that might be released. I think it's going to be interesting reading the latest minutes we get this week. The reason why is because these are the meeting minutes from the most recent decision that the Fed made when there was some conflicting dissenting. You had someone saying, "Hey, I want more aggressive of a cut." A few were saying, "Hey, no, I don't want any action taken. Let's hold rates steady." So, had quite a diversity of views that will make the upcoming minutes to that meeting important, worth watching, probably more than the stale jobs report. And the reason why we're saying stale is because it's for the month of September, should have been released 5 weeks ago, but the government shut down before it was released. The government did not shut down before the data was collected. That's why we're getting this September jobs report. And looking ahead, we are going to have an October jobs report coming as we would expect. However, that's going to be a little bit unusual. We'll get data from the establishment survey, that's businesses. We will not likely get any data from the household survey, meaning no one made those calls to households. The qualitative component of the jobs report, that's going to be missing. Things like the unemployment rate, the underemployment rate comes from the household survey. We will not get those for October.
Yeah, now claims we're going to continue to get, right, Jeff?
So
That's
that'll be,
out
yes,
of the
that's a very helpful higher frequency data point when you think about those that are collecting initially or continuing. We call them continuing claims or initial job claims. Those that are applying for unemployment insurance benefits because they were let go. Hence, that's a good proxy for what we won't get with an October unemployment rate. We will get with October initial and continuing unemployment claims.
Yeah, so we'll certainly watch for claims. Maybe I should have starred that one because it's collected at the state level. We actually have that data.
Hmm.
So yeah, maybe it's a little more interesting week than I led you to believe here when I set this up. Now earnings are going to be very interesting, not just because NVIDIA is the biggest market cap name in the S&P 500 and they report Wednesday after the close, but you also get a bunch of retailers, and so we're going to get a feel for how the consumer's doing. Retail is also interesting because they report late. So I'm talking about Target and I got Walmart, Home Depot, a bunch of others. Because they report late, we're going to get a more recent look at the consumer than we would have gotten from a company that reported that's on a September quarter end and reports in mid-October. So that is going to be important. It's only, I think, 13 companies reporting this week, but so many of them are retail that we'll get a look at the consumer. So I think that's really it. Those are the things to focus on. And then we'll have to continue to watch any AI headlines that can help us assess whether that spending is really going to come through. My guess is we don't get anything this, not just this week, but this month that tells us that spending won't come through. If we are going to get that, it's probably going to come in 2026. But that is a constant watch, I think, every week as we go forward to take the temperature of AI. All right, so that's all we got. So thanks, Jeff, for joining and walking through some of your keys for 2026 and helping us not only recap but preview the week ahead. Thank you to all of you for listening to another LPL Market Signals. Apologies for the voice. I made it through. I played hurt and survived the game. So we will be back with you next week for another episode. See you then and take care.